When equity markets crash, there are certain assets which gain in value, and these are called safe haven assets. So that would be things like developed market government bonds or gold. But there's another asset class which also gains in value called volatility. Now you can get access to volatility through exchange traded products, but this is much more complicated than something like a treasury or gold. So in this video, we're going to look at the ins and outs of volatility and a complication called roll cost. Now, if you do want to learn more about investment, what better way could there be than to get our free weekly market roundup? There'll be a link in the description below, and there'll be a link above me as well. So now let's look at exchange traded products which give you access to volatility in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start by looking at the definition of volatility. Merriam-Webster defines it as a tendency to change quickly and unpredictably, and they use the example of the stock market. A secondary definition, which might also apply to markets, is that it's a tendency to erupt in violence or anger. And if, like me, you've ever lost money in a sell-off, perhaps that's a better definition. But in fact, there are two types of volatility. Realized volatility is what actually happens to the price of an asset, and it's defined mathematically as the typical daily percentage price movement. But the other type of volatility, which can actually be traded, is called implied volatility. And this is a value of volatility which is backed out of something called an option. Intuitively, we can all understand realized volatility. So here's a really safe fund from Vanguard called a money market fund, which is very much like cash. It has a very low risk and a very low return. And the typical annual percentage price move is just 0.2%. You can see that if we put £1 into this fund at the beginning of this period and then track it over time, it's still worth very close to £1 at the end of the period. Whereas if we put £1 into an emerging market equity fund, which has a volatility of 27%, you can see that it's a much more rocky ride. Now that's risky because a very large price move downwards is much more likely with this EM equity fund than it is for the money market fund. And if we look across lots of different assets, and this is just a subset of the funds offered by Vanguard in the UK, you can see that the volatility is highest for the equity funds, with emerging markets being the riskiest of all, with a volatility of about 20.4%. Then as we go through developed markets, the volatility decreases. These three all-world funds give you access to equity all over the world. These are very well diversified, and so they have a slightly lower volatility than the other equities, of around 16%. And then we get into the bond space, which again has lower volatility, and the funds with the shortest duration have the lowest volatility. Now, just as we have indices for stocks and for bonds, and these indices give us a broad view of an entire market. Now, there's also an index for volatility, and this is called the Vix Index. You'll often see it referred to in the media as Wall Street's fear gauge, because when people are scared and equity markets are selling off, the value of VIX increases. SIBO in the US is responsible for calculating VIX, and SIBO stands for the Chicago Board Options Exchange. So the first thing to know about VIX is that it represents a 30-day expected volatility of the S&P 500. So in other words, it's forward-looking and it's just a market expectation. The actual realized value of volatility over the coming month will always be different from that expectation. The second thing to know is that it's constructed with put and call options on the S&P 500, which have expiries of between 23 and 37 days. So they bracket that 30-day period. So the upper panel here shows the S&P 500 since 1990. And the lower panel is the value of VIX. Now notice when the value of equity falls very sharply or quickly, you tend to get a spike in VIX. We saw a very large spike in VIX in 2008 and 2009 during the global financial crisis, where it peaked above 80%, and we also saw a spike in March 2020 as a result of the pandemic. But notice that there's also a kind of base level of VIX, which varies slowly over time. So this was a high volatility period around 2000, then we had a lower period leading up to the financial crisis, and then we had another low volatility period after the global financial crisis, which coincided with the rapid rise in the value of equity prices in the US. Now, one of the strange aspects of VIX is that you can't trade it directly. But professional investors have access to something called Vix Futures, and these allow professional investors to take a view of what VIX will be at fixed expiration dates at monthly intervals in the future. These futures make it as easy to go long volatility, in other words make money if VIX rises, or short volatility, which means you make money if VIX falls. These VIX futures are also very liquid, which means they're very easy and cheap to buy and sell. But as we'll see, the exchange-traded products that give you access to volatility access the VIX market via these VIX futures. So this is a period from summer 2018 until the beginning of 2019, and I've shown the Vix Index in green. And the red line shows the value of the Vix 2018 January future. Now this was a very low volatility period when the actual value of VIX was bouncing around 11%. But you can see that the expectation from the futures market was a value of VIX that was much higher, at about 17%. But as the January expiry of this future drew nearer, notice how the VIX future converges with the price of VIX, such that on the expiry day, they're exactly equal. So sometimes the VIX futures will be below, and sometimes they'll be above the actual level of VIX, reflecting views about what's going to happen. For that same period, I've shown in this graph the value of several futures contracts. Notice how they have a code followed by a year. Now the month codes are fairly arbitrary, and they range in not quite alphabetical order from F for January to Z for December. So the red line here is the contract we saw before, which is the January 2018 expiry VIX future. And this is its price over its lifetime until it expires in January. Then the February contract is G18, which is this line here. And you can see the volatility there is a little bit higher. Now this low volatility period ended when equity markets sold off at the beginning of 2018, which resulted in this spike in all of the VIX futures contracts. And if we zoom in on that spike, you'll notice that what used to be the lowest volatility now becomes the highest. So if we take a snapshot of the VIX futures prices on January the 22nd, when volatility was low, and the expiry dates of the futures contracts range from G18, which is the February 2018 contract, all the way up to U18, which is the September 2018 contract. And you can see that really clear upward sloping structure to the volatility expectations. Now that's fairly typical during quiet periods, when equity markets are rallying and when volatility is low. But then on February the 5th, when volatility spiked, firstly the whole curve shifted upwards, so the volatility now ranges above 30% down to just below 20%, which is actually off the scale of the graph here on the left, and now the curve is downward sloping. One way of interpreting this is that during good times when volatility is low, futures markets expect volatility to increase, and the further out in the future, the higher the volatility expectation. Whereas when volatility spikes, the expectation is that volatility will then fall in the future. So let's take that normal shape when volatility is low and make it more diagrammatic. So here's the 1 month VIX future, the 2 month, all the way up to the 7 month VIX future with a gradually rising price. Now let's imagine for a moment that it's our job to create an index which tracks VIX futures. If we buy the 7 month VIX future contract today, then in 1 month's time, that will become the 6 month contract. And when another month goes past, it'll become the 5 month contract. But if we reach 1 month, then eventually our contract will expire. But if we're running an exchange traded product which is linked to volatility, we can't let that happen. We always have to maintain a volatility exposure. So what these fund managers do is to always sell the front month contract and then roll the money further up the curve and buy this futures contract. So there's a continuous treadmill where you're buying the far contract and selling the near-term contract. But because the price falls over time, that means you're continually losing money, and that's called roll cost. Now the curve is flatter out at the longer dated contracts, so the roll cost is lower if you're rolling between the 7th and the 6th month contracts, for example. But if you're rolling between the 2nd and 1st month contracts, the curve is steeper and you'll lose money more quickly while volatility is low. And that's why when you buy volatility exchange traded products, they make it very clear which part of the futures curve you're getting exposure to. So the most popular contract in the United States is VXX, which is issued by iPath, and it gives you exposure to short-term VIX futures, as does VixY, which is issued by ProShares. Whereas the next two products give you access to midterm futures, and they will have a lower roll cost. And we'll also look at this dynamic VIX exchange traded note. Now notice that some of these are ETNs. They're not exchange traded funds. An exchange traded note is simply a bond issued by a company where they promise that they'll link the price of the bond to the value of some index, which in the case of these products are indices created by S&P which track the VIX futures curve. If you read the term sheet of these ETNs, you'll see that the value of these notes depends on the ability of Barclays Bank plc, which creates the iPath products, to satisfy its obligations as they come due. And that means that one of your risks is the creditworthiness of Barclays Bank. So let's say that Barclays Bank got downgraded by S&P or Moody's, and its perceived credit risk were to increase. That would actually reduce the value of the ETNs, which are issued by Barclays, even though the value of VIX needn't have changed at all. Whereas for exchange-traded funds, those won't be affected by the creditworthiness of the issuer. Now, if we do look at the term sheet of VixY, which is one of the short-term VIX futures products, ProShares makes it very clear that this is not intended for long-term use. It's only intended for short-term use, and that's because of the roll cost. This product will lose money over time if VIX doesn't increase in value. And the second thing they point out is that it doesn't track the value of VIX. As we now know, it actually tracks a dynamic position on the VIX futures curve. If we actually look at the S&P indices which these products are tracking, and I've highlighted the two that we've seen so far, which is the short-term futures index and the mid-term futures index, you can see that the short-term index is exposed to the first and second month VIX futures contracts, whereas the mid-term futures index has exposure to the 4 to 7 month VIX futures contracts. So this product will be continually selling the first month contract and buying the 2-month contract, whereas products that track this index will be selling the 4th month contract and buying the 7-month contract. And they do that continually in order to maintain exposure to VIX futures. Now we can do a side-by-side comparison of the short-term product and the mid-term product offered by ProShares. Now the first thing which should worry you is that the average annual return for the short-term Vix Futures ETF is a loss of almost 45% every year. And that's a direct result of that roll cost, which is greatest at the short end of the curve. Whereas for the mid-term futures contract, the roll cost is about half as much, but it's still about a fifth of its value every year. Now during this year, when equity markets had a sharp fall and volatility remains high, the return has been very good. So 127% up to June for the short-term contract and 90% for the mid-term contract. If we look at the short-term futures ETF, you can see it has exposure to the July and August VIX futures contracts as of June 2020, whereas the mid-term ETF has exposure to the October to January VIX futures, and these will expire between 4 and 7 months from June 2020. Now, if you do use these products to hedge, and remember it can't be a long-term hedge because of the roll cost, but if it's a short-term hedge, the important thing is that it's negatively correlated with the S&P 500. So when the S&P 500 falls, this rises in value. And the correlation is roughly the same for both of the ETFs. However, the key thing is the beta, which tells you the multiplier between S&P 500 returns and the returns of these products. So on average, if the S&P 500 falls by 1%, the short-term ETF will gain 3.4%, whereas the mid-term ETF would only gain 1.5%. So although the roll cost is bigger for the short-term ETF, its gains are larger when the S&P 500 falls, or equivalently when VIX rises. So as you'd expect, the correlation with VIX is positive. However, the beta is certainly not 1, which is another way of saying that the short-term ETF doesn't rise 1 for 1 with VIX. If VIX goes up 1%, this only goes up 0.6%, and the midterm fund is even less sensitive. If VIX goes up 1%, this only goes up 0.2%. Now, in many cases, it's simply not practical to have that continual negative roll cost. So S&P has created something called the Dynamic Vix Futures Index. This continually monitors the steepness of the VIX futures curve, and it uses that steepness to work out what the future expectations are of market volatility. And the clever bit is that it dynamically allocates between different positions across the VIX futures curve. And the purpose of this machinery is to lower the holding cost over time, so the roll cost isn't as large as it is for the other products. To see those compared side by side, I've got the value of ProShares VixY and VixM, so that's the short and mid-term ETFs, alongside XVZ, which is an iPath ETN, which tracks a dynamic VIX Futures Index. And you can probably tell that the roll cost for this fund is much lower than it is for the other two, and that's by design. If we compare those three funds on a risk-return plot, with high risk on the right and low risk on the left, and low returns on the bottom, and high returns at the top, all three of these funds have a negative return over the period between 2011 and 2020. But the roll cost of this product, the Dynamic VIX ETN, is only about 4% per year, whereas the midterm futures ETF loses about 20% and the short-term futures ETF loses almost 50%. You can also see the volatility of this Dynamic VIX ETN is much lower than it is for either of the other two products. But this is still a far cry from treasuries, which generate a positive income if you hold them, which is why for most people, treasuries and government bonds are a much better equity hedge. So here I've tracked the value of $1 invested into those three funds at the beginning of 2019 over the course of the following year. XVZ loses the least, exactly as you'd expect. The midterm VIX futures product, VixM, loses a little bit more, and the short-term VIX Futures ETF loses the most. It loses more than half of its value over the course of 2019, which is why you almost certainly wouldn't want to hold either of these products over a long period of time. But if we look at the value of these three products over the course of 2020, which of course was a very different year, you can see that $1 invested in VixY, which is the short-term VIX Futures contract, increased in value in March to over $5. And because volatility remains high, it hasn't lost all of that value due to roll cost, at least not yet. Whereas the Dynamic VIX tracker and the midterm VIX Futures tracker, although they both doubled, are far less sensitive to that pickup in volatility compared to the short-term VIX Futures product. But because they lose less due to roll cost, they're now roughly on a par with the value of the short-term ETF, which is twice what they were worth just before the big sell-off in mid-February. And if we plot the daily return of the S&P 500 on the x-axis versus the daily return of each of these products, you can see the greater sensitivity of the short-term product. And that's why it performed better in 2020. An alternative hedge would be intermediate 7 to 10 year US Treasuries, which is what you get exposure to with the iShares IEF fund. If we look at the correlation of the S&P 500 tracker SPY with the midterm futures ETF VixM, the correlation's minus 0.8. Whereas for 7 to 10 year treasuries, the magnitude of the correlation isn't as large. It's only minus 0.5. If we track that correlation through time, so this is the value of that correlation over successive 1-month periods, ranging from 2011 up to August 2020, you can see that the midterm VIX Futures ETF is much more reliably negatively correlated with equity than 7 to 10 year treasuries. There are several 1-month periods where the correlation between treasuries and equity actually became positive, which is indicated by these blue bars. So buying exposure to VIX Futures is certainly a more reliable hedge than US Treasuries. But of course it comes with that massive problem, which is the negative roll cost. So these VIX exchange traded products are very attractive from one point of view, which is that they're very consistently negatively correlated with equity, more so than even treasuries. But the drawback is that you have to time your entry into the hedge perfectly, or at least quite well, because you're going to have that negative roll cost while you hold the hedge. So that's why I personally prefer things like developed market government bonds as an equity hedge. If you enjoy our videos and you want to support us, then you can do that really easily by going to Patreon. There's a link above me on this page. And if you do that, you get access to lots of great stuff. You can ask questions of me and other members of the community via this application for chatting to each other called Slack. We also have a very friendly, regular call on a Sunday evening where you can ask any question you like and I answer them live. There's also a video replay which is available afterwards. And we have a growing library of explainers which are exclusively for our members. And you can see 2 of the latest examples of that here beside me. And alongside the video, you also get access to the notes so that you can research each topic in more detail yourself. So if you do want to join us or just support us, then click on that Patreon symbol on the far side of the page. It would be wonderful to see you as part of the community. And as always, thank you for listening.